Hi CA students, let's revise CA Final AFM Chapter 6 Portfolio Management. Practical question 9. The distribution of return of security F and the market portfolio P is given below. Probabilities are given and return of security F and market return is given. You are required to calculate the expected return of security F and the market portfolio P, the covariance between the market portfolio and security and beta for the security. So here there are three requirements. One is expected return for security F and expected return for portfolio P and the covariance between market portfolio and security and the beta for the security. So the expected return can be directly found out by multiplying the probabilities with the return. We'll get the expected return for F and P as well. So the expected return of security F is 17 and market portfolio is 14 as a direct multiplication and summation. And the second requirement is covariance between market portfolio and security. Covariance can be found out by the summation of the return F minus expected return multiplied by market return minus the expected market return multiplied by the probabilities. So this F minus F bar is nothing but the deviation. Now we have the expected return, and if we reduce it from the actual returns, we'll get the deviation. Then we need the square of the deviation to find out the standard deviation in both the cases. So the variance for security F is 141 and the standard deviation is 11.87. Now keeping this aside, we need the deviation. So deviation is 13, 3 and 17, and in case of the market portfolio, the deviation is 24, 6 and 16. Now the deviation of security F multiplied by the deviation of market portfolio multiplied by the probabilities will give us the covariation. So as we can see here, 93.6 is nothing but 13 multiplied by 24 multiplied by 0.3. So 13 multiplied by 24 multiplied by 0.3. So 13 and then 24 is negative, so the resultant will be in negative. So we are getting a covariance of 168. Now the third requirement is beta for security. So as we have previously studied, beta is nothing but the sensitivity of a specific stock's return that changes in response to market movements. So in the current case, security F's sensitivity towards market return, which is P, that will be the beta. Now in the previous practical questions, we have seen, let's say in question number 8, we have calculated beta value, wherein we have used this formula, which is a simple regression method. That is a simple regression formula wherein it gives equal weights to all the returns. So let's say in the previous question, Krishna Limited and market index we have calculated. So wherein the equal weightage will be 0.33, 0.33 and 0.33. That will be the probabilities. So equal weights will be given to every security, so the simple regression formula will work. But in the case of our current question, wherein the probabilities are given, so simple regression formula will not give us the exact results. We have to use more defined approach, which is nothing but this covariance and variance approach, wherein it will account for the probabilities of the expected returns also. So the beta formula will be covariance of F and M divided by variance of market portfolio return. In our case, 168 is the covariance and market returns variance is 264. So will give us 0.636, negative 0.636. That will be the sensitivity of return F towards market portfolio. So in exam perspective, it is so simple. If the question expects us to calculate beta, first check whether probability is there or not. If probability is there, use this formula, covariance of the return multiplied by the market return divided by variance of market return. If probabilities are not there, then we can go ahead with this simple regression method, wherein the summation of the securities return multiplied by market return minus number of items multiplied by the expected return multiplied by the expected market return divided by the summation of market return square minus the number of multiplied by the expected return square, which will give us the beta. Thank you.